You know, I got to task me what's really going on in the silver market. I always tell them the same thing. You can't understand today's price action unless you understand how distorted the system has been for decades. Because what we're watching right now isn't a rally. It isn't speculation. It isn't even excitement. It's the slow, visible cracking of a structure that's been uh, artificially held together for far too long. And I'll say this right up front. I've been involved in this market for a very long time. I've seen every cycle, every narrative, every excuse. And what we're seeing now is fundamentally different from 1980, different from 2011, and different from anything in between. This is not a blow off move. This is a repricing. Let's start with something simple, the math, because markets can lie, but math doesn't. Silver is mined at roughly an 8-to-1 ratio compared to gold. In the Earth's crust, it's closer to 10 or 11-to-1. That's geology. That's chemistry. That doesn't change because of sentiment or headlines. And yet, for most of the past decade, silver has traded anywhere from 60 to 100 times cheaper than gold. Now explain that to me. You can't, not honestly, because if this were a free market, a real price discovery mechanism, silver wouldn't trade at a fraction of its natural occurrence. It would oscillate, sure, but it would revert to a rational relationship. Instead, we've had decades of distortion, and that distortion has a name: paper leverage. For years, a small group of banks controlled the silver market through derivatives, futures, swaps, unallocated contracts, instruments that allow enormous supply to appear without a single ounce of physical metal ever changing hands. People used to call it hedging. That story doesn't hold anymore. Nobody hedges like that now. Not miners, not manufacturers, not refiners. That excuse might have worked 20 years ago, but today it's nonsense. What you've really had is a structural short position, massive, persistent, and concentrated. And here's the thing most people miss: that structure only works as long as physical metal is abundant and ignored. The moment real demand shows up, the moment people say, want delivery, not exposure, the whole system starts to creak. And that's exactly what's happening now. Um, let's talk about what's actually going on under the surface. Just the other night, roughly 70,000 ounces of silver were demanded almost overnight. That's about 200 million worth of physical metal in one shot. That's not a hedge fund playing games. That's a buyer who needs real silver. And this isn't isolated. This is becoming regular behavior. You look at Clamex deliveries, actual deliveries, not paper volume, and they're rising after price moves higher. That's important. Historically, when silver rallied, physical demand would fall off. People would step back. That's not happening now. Demand is accelerating with price not against it. That tells you everything. And then you have China. This work has really start to change. China has announced that as of January 1st, silver exports require permits. They were one of the world's largest exporters. Depending on how strictly that's enforced, we could be talking about 50 to 100 million ounces removed from the global market. Just gone. At the same time, China is the largest consumer of silver in the world. Solar panels, electronics, industrial components, advanced batteries, it's all there. So you have the biggest supplier becoming more restrictive while also being the biggest buyer. That's not a cyclical shift. That's a structural one. And yet most investors haven't adjusted their thinking at all. They still believe London and New York set the price. They don't. Not anymore. The London Bullion Market Association and COMEX used to dominate price discovery because they controlled liquidity. But they did bet by trading paper, enormous amounts of it, with very little physical settlement. Shanghai is different. Shanghai delivers metal. That changes everything. When price discovery moves to a market that requires physical settlement, the entire dynamic shifts. You can't rehypothecate it endlessly. You either have it or you don't. And this is why I keep saying that the real center of gravity is moving east. People still think New York opens the day. It doesn't. The market moves overnight now. Asia sets the tone. Europe reacts. New York follows. That's a reversal of decades of financial hierarchy, and it's happening quietly. You can see it in the price behavior. Silver sells off hard for 10 minutes, bang, bang, and then quietly recovers everything. That used to scare people. Now it doesn't, because physical buyers step in. They're not emotional. They're not leveraged. They're buying because they need metal. And that's why these smashes don't stick anymore. I always say, if someone keeps slamming the price down and it keeps bouncing back, ask yourself, who's losing? It's not the longs, it's the sellers. And that's where the risk really lies. Now let's talk about ratios for a moment. If gold goes to 4,500, and that's not some wild fantasy in a world drowning in debt, then even a conservative gold to silver ratio of 50 1 puts silver at 300. That's without any supply disruption. That's just normalization. And we're nowhere near normal because we all have to talk about inventories. Global silver inventories are thin, dangerously thin. We're not talking about little tight. We're talking about levels that would not survive a sustained increase in industrial demand. People assume stockpiles are massive. They're not. And here's the kicker. Much of what's counted as inventory is already spoken for, at least promised, allocated in ways that can't be called back easily. So when someone shows up and wants physical silver now, the system strains. That's why I say we're closer to a tipping point than most realize. And this is where the conversation always shifts to demand, because people think silver is just a monetary metal, or worse, a speculative trade. It's not. It's an industrial necessity. And that brings what I think is one of the most appreciated developments in the entire market. Solid state batteries. Samsung announced a battery that charges in 9 minutes and delivers around 900 kilometers of range. Think about that for a moment. That's not incremental improvement. That's transformational. And each one of those batteries uses roughly 1 kilogram of silver. Now let's do the math. If even 20% of global EV production adopts that technology, it consumes the entire annual global silver supply, all of it. That's before solar panels, before electronics, before medical use, before jewelry, before investment demand. So ask yourself, where does the silver come from? Because it doesn't appear magically. And this is where the market narrative breaks. People still think silver is abundant. It isn't. People think miners can just ramp production. They can't. New mines take a decade or more. Permits, capital, infrastructure, it all takes time. Meanwhile, demand doesn't wait. And this is why I say we're not talking about price spike. We're talking about a structural repricing of an essential material. Now, let's talk about something else people overlook: ownership. Most of the silver in the world is not held by weak hands. It's held by long-term holders, institutions, and increasingly governments, industrial users. These people are not traders. They don't care about a two-eyes dip. They care about supply security. And once they decide they need silver, they don't sell it back into the market. They lock it up. That's why the float is shrinking. That's why paper volatility doesn't matter as much anymore. And this is why the old playbook uh, is failing. You can see it in the behavior of the banks. They used to be the sellers. They used to control the market. Now they're quiet. And when banks go quiet, it usually means they're repositioning, because here's the uncomfortable truth. If the banks ever become net buyers of silver, the market will have no shock absorber. None. There won't be enough metal to meet demand. And when that happens, prices don't rise smoothly. They gap. This is why I keep saying that the risk isn't that silver goes down. The risk is that it reprices so fast, most people don't get a chance to participate. And this is where we start to talk about opportunity, because the metal is only part of the story. Oh, I got to tax it. The real leverage is in the companies that control ounces in the ground. Now, once you understand that silver isn't just a metal, but a structural input, something the modern world literally cannot function without, the next logical question becomes, where does the leverage actually live? And this is where most people get it wrong. They think leverage means futures contracts or options or trading volatility. That's not leverage. That's noise. Real leverage comes from ownership of ounces that the world suddenly realizes it cannot replace. That's where mining equities is enter the picture, and why they're so profoundly misunderstood. You see, people look at mining stocks and say they're risky, and sure, they can be. But risk has context. A miner with no deposits, no permits, no infrastructure, that's risk. A company sitting on hundreds of millions of ounces of silver in a world that's structurally short silver, that's not risk, that's leverage. And right now, the market's pricing those assets as if silver were still a 20 TB. That disconnect is staggering. Let's talk through the math slowly, because this is where people finally start to understand how upside compounds. Imagine a company with 5 billion ounces of silver equivalent in the ground at 25 silver. That's roughly a 37. 5 billion in metal. The market might value the company at $1 or $2 billion if that. Now move silver to 150. That same metal elf is now worth 225 billion. Nothing changed except the price. The ground didn't move. The geology didn't change. The ounces didn't disappear. Yet the market value should. And this is where most people freeze because they can't emotionally accept numbers like that. They feel too big. But they're not. They're simply the logical outcome of repricing. And here's the key insight: markets don't move linearly when supply is constrained. They move in steps. First, nobody believes it. Then a few specialists believe it. Then institutions wake up. Then everyone else panics. We're somewhere between stage 1 and stage 2. And the reason this matters so much is because the silver mining universe is small. Tiny, actually. There are maybe a few dozen companies globally that matter. Companies with real resources, jurisdictional stability, and a pathway to production. And many of them are trading at valuations that imply silver will never move again. That's absurd. Now, let's talk about the elephant in the room: permits and governments. People love to say, well, governments won't allow these mines to operate. I've heard that my entire career. But here's the reality: governments love revenue. They love jobs. They love royalties. They love taxes. When commodity prices rise, suddenly environmental concerns become manageable challenges. It happens every time. Look at history. Look at copper. Look at oil. Look at uranium. When prices rise high enough, approvals follow because governments run on money. And when silver price rise, the incentive to bring supply online becomes overwhelming. This is why I'm not worried about permitting in the long run. Delays? Sure. Denials? Rare. Say in jurisdictions that already rely heavily on mining revenue. Now, let's talk about some of those people consistently underestimate time compression. Markets don't move smoothly from undervalued to fairly valued. They stall. Then they lurch for years, and then suddenly everything happens at once. That's what creates generational opportunities. Look at uranium. For a decade, nothing. Then suddenly contracts are being signed at prices no one believed possible 2 years earlier. Silvered up the same way, except its industrial footprint is broader. And here's the key difference: uranium demand can be deferred. Silver demand often cannot. You can delay a reactor. You can't bid a battery without silver. You can't produce electronics without silver. You can't maintain modern infrastructure without silver. This is why I keep saying silver is not just a monetary metal. It's a strategic metal. Now let's talk about the psychological shift that's already underway. For decades, investors were conditioned to think that precious metals were barbarous relics, outdated hedges that only mattered during crisis. That narrative is collapsing. Central banks have been buying gold aggressively. That's not a coincidence. That's a signal. They understand currency debasement better than anyone because they create it. Oh, I got Central Max. Don't buy silver directly. Their actions set the stage for silver's revaluation. Gold leads, silver follows, but when it moves faster. That's the pattern. And right now, gold has already broken out. Silver is just waking up. You can see it in the way silver refuses to break down. Every sell off is met with buying, and every dippy is shallower. That's accumulation. And when accumulation ends, price discovery begins. Now, let's talk about one of the most misunderstood aspects of this market: inventory visibility. People assume inventories are transparent. They're not. We have rough estimates, disclosures, and reports, but much of the silver market operates in opacity. Leases, swaps, off balance sheet arrangements. And when stress appears, that opacity becomes dangerous because suddenly everyone wants to know who actually has the metal. And that's when trust breaks. This is why I keep emphasizing that when banks shift from being sellers to buyers, the entire system flips. They'd make a 25. What are these that used to provide liquidity start hoarding metal? There is no backstop. That's a price as whatever someone is willing to pay to secure supply. Now let's come back to industrial demand again, because this is where the narrative becomes undeniable. Solid state batteries aren't a future fantasy. Uh, they're already being tested. They're already being scaled. And when manufacturers like Samsung commit to a technology, they're not guessing. They're planning years ahead. They lock in supply contracts. They secure materials. They don't wait for spot prices. That means silver demand is being pre-booked years in advance. And once those contracts are signed, that metal is effectively gone from the open market. This is how shortages form quietly, not through panic, but through planning. And when the market finally realizes what's happened, the reaction is violent. Now, think about the psychology of investors at that moment. They'll say, I knew silver was important, but I didn't realize it would happen this fast. That's always how it goes. And that's why positioning early matters. Because once the narrative flips, it's too late to get meaningful exposure without paying for extreme prices. Let's talk briefly about silver equities again, because this is where most people still hesitate. They say, what about dilution? What about costs? What about management? Those are valid concerns. Oh, in a rising commodity cycle, when the underlying commodity triples, oh, or quadruples, even inefficient operations become enormously profitable. A deposit is marginal at 25 silver becomes a cash machine at 150. And that's before considering takeovers. Because once realized they can't replace reserves organically, they buy. Buy them. This happens every cycle, and it's already starting. The smart money is looking for scale, ounces in the ground in safe jurisdictions with infrastructure nearby. They're not looking for perfection. They're looking for leverage. And the beautiful thing about silver is that it offers leverage in abundance. There are dozens of companies that could re-rate dramatically, not because management suddenly got smarter, But because the price of the metal forces reassessment, this is why I keep telling people, don't overcomplicate it. You don't need to time the exact top or bottom. You need to understand the direction and the magnitude. And uh, the magnitude here is enormous. We are not talking about a 20% move. We are talking about multiples. Oh, that's uncomfortable for people who've been conditioned to think in small increments. But markets don't care about comfort. They care about supply and demand. And right now, supply is constrained, demand is accelerating, and confidence in fiat systems is eroding. That's a powerful combination. Now, before we move on, I want to touch on something psychological, because this is often where people sabotage themselves. When prices start rising, people feel smart. When prices rise more, they get nervous. And when prices go parabolic, they freeze. They sell too early, or they don't act at all. The key is understanding that this isn't a trade, it's a structural shift. We're not chasing momentum. We're aligning with necessity. Silver is essential to the modern economy in a way that wasn't true even a decade ago. And markets always underprice necessity until they don't. So when people ask me, isn't it too late? I say, it's not even started, because the world hasn't yet priced in what silver actually does. And when it does, the adjustment won't be gentle. It will be fast. It will be disorderly. And it will reward those who understood the setup before the headlines caught up. In part 3, uh, I want to talk about the final piece of this puzzle, the behavior of governments, banks, and institutions when the realization finally sets in, because that's where this story truly accelerates. At some point, every system reaches a moment where it reveals what it truly is, not through headlines, not through tax, but through behavior. And in markets, behavior always changes before narratives do. Right now, we're approaching that moment in silver, because once governments, institutions, and banks start behaving differently, not talking differently, acting differently, something fundamental has shifted. And that's exactly where we are. Let's start with governments, because they always tell the truth eventually, not with words, but with actions. For years, governments treated precious metals as irrelevant. Gold was a relic. Silver was industrial scrap. They printed, borrowed, spent, and assumed confidence would never waver. But quietly, behind the scenes, something changed. Central banks began buying gold again, not symbolically, aggressively. This wasn't ideological, it was defensive. They saw the debt trajectories, they saw the structural deficits, they saw the fragility of the system they were operating inside. And they responded the only way rational actors do when trust erodes, by accumulating real assets. Now, they don't buy silver directly, but make no mistake, silver is downstream from gold. When gold reprices, silver revalues. That distinction matters. Gold moves because of monetary stress. Silver moves because of monetary stress and industrial necessity. That dual role is what makes silver so volatile and so powerful. Now think about what's happening geopolitically. Supply chains are fragmenting. Trade blocks are forming. Energy security is no longer theoretical. It's existential. Every major economy is racing to secure inputs: copper, lithium, nickel, rare earths, and silver. The idea that silver will remain abundant and cheap and that that environment is simply unrealistic. And yet, and all that, that's still how it's priced. This is the disconnect. Now let's talk about banks, because this is where the real tension sits. For decades, bullion banks acted as market makers. Vaping provided liquidity, took the other side of trades, and smoothed volatility. But that only works if they can source metal when needed. When physical supply tightens, their role changes. They stop being intermediaries and start becoming risk managers. And risk managers don't short what they can't source. They reduce exposure. They step back. They let price move. This is why we've seen strange behavior recently, sudden drops that don't hold, followed by quiet accumulation. That's not manipulation in the old sense. That's retreat. And when the largest players step back, the market becomes much more sensitive to real demand. That's when price discovery accelerates. Now, think about what happens when industrial users realize supply is no longer guaranteed. They don't wait. They pre-purchase. They over-order. They stockpile. And when that happens, available supply vanishes faster than anyone expects. We've seen this movie before in energy, in semiconductors, in fertilizers. Silver is no different. The only reason it's different is because people still think of it as a metal trade, not a strategic input. That misconception won't last. Now let's talk about investment behavior, because this is where psychology takes over. Most investors don't buy early. They wait for confirmation. They want to see price strength, media coverage, analyst upgrades. But by the time all of that shows up, that easy money is gone. We're currently in the phase where prices are rising, but belief hasn't caught up. That's the sweet spot. Once belief sets in, flows explode. And when flows hit a market as small as silver, the result is not gradual appreciation, it's repricing. This is why I keep emphasizing scale. The silver market is tiny compared to global capital flows. Even a modest reallocation, 0.5%, would overwhelm supply. People talk about trillions sloshing around the financial system. That money doesn't need permission. It just needs a reason. And silver is giving it plenty. Now let's have something most people overlook: trust. Markets are ultimately trust systems. You trust that your money holds value. You trust that contracts will be honored. You trust that supply will be there when you need it. When that trust erodes, behavior changes fast. And right now, trust is eroding across institutions. Government stability while expanding deficits. Central banks claim control while inflation proves otherwise. Financial markets appear liquid until an environment, tangible assets gain premium. Not because of fear, but because of reliability. Silver doesn't default. It doesn't get bailed out. It doesn't need confidence. It just exists. And that's why historically Silver has always played a role during transitions, not at the beginning, but at the inflection point. That's where we are now. Now, let's talk about timing because people always ask, when does this happen? The honest answer is no one knows the exact moment, but we do know the conditions. You'll see increasing delivery stress. You'll see more talk of supply chain resilience. You'll see governments quietly securing resources. You'll see banks reducing exposure rather than increasing it. And you'll see prives that don't make sense under the old framework. Those are the signals. When you see those signals, you're already late, but not too late because repricing doesn't happen in a day. It happens in waves, and each wave leaves fewer opportunities behind. Now, let's talk about the final piece, psychology during the breakout. When silver finally moves decisively, the narrative will flip almost overnight. The same commentators who dismissed it will suddenly discover it. They'll say it's a hedge, a necessity, a strategic asset. They'll talk about shortages as if they just appeared. But those paying attention will know the truth. The shortage was always there. It was just hidden behind paper. And when that paper fails to satisfy demand, the repricing becomes unavoidable. At that point, you'll hear things like, we didn't see this coming. This is unprecedented. We need emergency measures. Those phrases usually mark the end of a cycle, not the beginning. But for those positioned early, that's when patience pays off. Now, I want to say something very clearly. This isn't about fear. This is about realism. The world is changing faster than our financial models can adapt. And silver sits at the intersection of money, industry, and trust. That's why it matters. That's why it's different. And that's why it's misunderstood. People often ask me, what's the end game? The end game is simple. Silver reclaims its role as a strategic material priced accordingly, not manipulated, not suppressed, not ignored, just valued for what it actually is. And when that happens, the repricing will feel sudden, but it won't be surprising. It will feel inevitable because all the signs are already there. And the only real question left is this: will you recognize the shift while it's happening, or only after it's already happened?